Next question. How important are infinite returns on capital for an investment decision of yours? Is it more like the icing on the cake?
So this is risks getting mathematical here. But so there's the way I think of it has always been you're sounding very mathematical, but I've always said to people, look, your returns in a stock are going to approach two potential constraints, two limits that they could bump up against. One is your initial yield in it and stuff. So how cheaply are you buying something? So this is why, like, if you buy something at a PE of 1, you can get incredibly high returns. Okay. And if you buy something that has infinite returns on capital, you can get incredibly high returns. The problem is that most things are going to fall really in between that. And so what will happen is, like, if you buy something at a PE of 1, it goes to a PE of 5 in a year and you sell it, that's an amazing return. If you buy something with infinite returns on capital and hold it forever, okay, Amazon, we talked about it, it's like that's the kind of thing. On a cash basis, it's had nearly infinite returns on capital and stuff for a long time. So that's why you can have a very high return even though you paid a high price. So the answer is it's incredibly important as you approach anything that's a remotely high price. So it's really, really important to me. The only way that I'll pay meaningfully high prices that, like, I mean, not even prices that even other value investors consider pretty good prices,
like
but
20 to 30 times earnings
is if the company has infinite returns on capital. Because without that, it gets a little tough to get the kinds of returns that we would want. One thing that I think of when buying a stock, the common way of thinking about it is, can this return in a reasonable way? Can this return 10 times in 15 years? Okay. That's about a 17% annual return. The way you break that down is it's much easier if it's very cheap. So if you have a P of 4, then it could go to 12 or even 16, or it could go to 20 if people really believe this is a great company. So if it does something like that, it barely needs to grow at all. All it needs to grow at is 4 or 5% a year or something, or pay a 4 or 5% dividend yield if it goes from a P of 4 to 20. So it's often easier to find a company that's like completely just an okay company, perfectly good company that's trading insanely cheap. But if you're trying to say you're buying a company at an average PE, then infinite returns on capital become really important to me. So if you're seeing me buy something at 15, 20, 25 times earnings, you're not going to see me buying 25 times earnings probably. But if you're seeing numbers that are more normal PEs, 15, 20 and stuff, then infinite returns on capital become very important. And also, by the way, retaining almost all your earnings become really important. Like, I've looked at some things and talked to people about it. And one thing that'll surprise them is with banks, for most banks, it's not as important as you think what the return on capital is, because most banks pay too much out in dividends. But you do find a rare bank that actually has really good returns on equity and is retaining a huge amount. And so my valuation changes a lot because of that retention.
And to your case about paying 25 times earnings and the business having infinite returns on capital, that's because you're paying a lot for that future growth? Or you want to look cheap for that future growth, I should say?
Well, here's the deal. So, like, I always flip it. I actually think of it in terms of that, how much capital does it take to grow a certain amount? So let's say you pay 25 times free cash flow. Okay. So it has to be free cash flow, not just earnings. 25 times free cash flow gives you a 4% yield. Let's say you want 10, 11, 12% a year. Well, now you got to grow 6 to 8% a year. But if you're growing 6 to 8% a year with infinite returns on capital, see, without the infinite returns on capital, you then have to use some of your free cash flow. So that free cash flow is not truly free. People count it as free cash flow, but it's actually being reinvested in the business. So if it's 4% and that goes down to 2%, then we have a problem, because now I have to grow even 2% faster to get those kinds of numbers. So, I mean, a way of looking at it is, and it's not perfect, but an approximation that's very easy for people to do in their head is free cash flow plus growth. Now, this gets into issues of how long does that go on for? Does it go on for 100 years? Then it works. But if it goes on for only a few years, it doesn't work. But let's put that aside. Free cash flow plus growth. It's much easier usually to have a business that has a true free cash flow yield of 4 or 5% and also grows 4 or 5% a year to give you a pretty good return. Maybe not a lot better than the market, but not worse. That's usually a lot easier than the reverse of growing 10% a year or something like that. What happens is some people get excited about a business that's growing 10% a year while reinvesting every dollar it has. But actually, that's only a mediocre return. That's actually not that different than what the market will do, because you're using every dollar of your free cash flow to do that. So Yeah, it's the easiest way to think about it is free cash flow, meaning actual free cash flow we have to pay you even while we're growing, plus growth. Yeah.
And to his point about, is it more like the icing on the cake? And your point about 1 PEs, it was J&J Snack Foods. What was it, like 5 times, 6 times earnings? You remember what it was trading?
Well, J&J was like 11 or something.
Oh, it was 11? Okay.
And it went to the 30. But Village was.
Got it.
Yeah, so it went from 5 to 15 or something pretty quickly.